Hello, everybody. Very warm introduction, so thank you very much. So hello to those of you who know us already, and also to those who maybe have not come across us in the past. What I'm going to do is take you through for the next 20 minutes or so Impax's most recent financial results for the full year to the end of September 2022. So our financial year end is 30th of September. So for those of you that don't know us, we are an investment management business. Our business model essentially is to provide services to institutional investors and high net worth individuals around the world, investing in equities and fixed income. And we have an idea that we think is really well placed for making money for the next couple of decades, what we call the transition to a more sustainable economy, which is a capitalist idea, but also does speak very nicely to those with more sort of values-based investment objectives. So if we come to the next slide, please. This is a summary. So as Cliff said, I started the business in 1998, nearly a quarter of a century of experience. We have one of the world's largest investment teams in this area of investing. And we also have a brand that's recognized globally around the world. So with nearly 80% of our clients coming from outside the UK, we've got a fabulous base from which to grow further. We also have the capacity to manage around twice as much money as we're managing today. And our business plan is based on the organic growth to pursue that objective. So we have a scalable business model, and we should be able to expand on operating margin as we extend the business. Next slide, please. So what do we mean by the transition to a more sustainable economy? Well, those words chosen carefully, each one of them, because what we're trying to do is get across the fact that there are quite a number of sectors of the economy that are going through quite significant dislocation. Anyone who's thought about buying a new vehicle recently will know it's quite a difficult choice now between an electric vehicle or one powered by an internal combustion engine. So that electrification of the drivetrain or the disruption caused by technology and regulatory requirements in transportation is producing a big headache for incumbents, but also enormous opportunities for new entrants. Alongside that, transportation dislocation is a sectoral transformation in energy. We're all familiar with the pros and cons of wind farms and solar power stations, but there's more to come in smart grid, in interconnection, in energy efficiency, and in a move away from centralized generation to a much more nimble system that ultimately will be independent of fossil fuel prices. Similar revolutions underway in the financial sector as we move to fintech-enabled products and services in healthcare with huge scope for benefits from new forms of treatment and innovation right across the value chain. In the food sector, trying to get the 30% wastage in the food value chain down to much lower levels, and at the same time cope with changing tastes for consumers, and also potentially the requirement for less environmentally damaging food sources. So right across the economy, there are these transitions underway, which we think are leading to two major sources of opportunity for investment. One is high rates of growth, and the second is that sort of misunderstanding, mispricing that comes from the complexity, which is not that easy to navigate. So, for example, the hydrogen economy, which is being trailed in the newspapers at the moment, is potentially in the long term a way for the whole of society to move energy around much more efficiently without so much emissions of greenhouse gases. But price points for key equipment are way out of the league to be competitive at the moment, and there's serious questions about whether they'll ever become competitive. So just investing in that part of the economy is fraught with risk, and there are many overvalued as well as, in our view, undervalued companies linked to that transformation. So I've spent a minute and a half talking about the transition to a more sustainable economy without using the phrase ESG, impact investing, responsible investing, green taxonomies, or anything like that. So we try and steer clear of that language when we are communicating our investment ideas, because what we want to do is reassure our end clients that our activity is based on the real economics and trends in society, which are not dependent on fashion, fad, or morals or values. They are sort of following regulation and accelerated by smart business people following compelling business ideas. Next slide, please. So how do we make that work in practice? Well, over the years, we have developed a number of investment strategies, which we now group into two buckets. Environmental markets is our long-standing name for the thematic investing that we do in this space. For example, we have a water fund, we have a food fund, we have a fund investing in small cap stocks in the transition, which we call our specialist strategy. Alongside those thematic products, we have our more core-based products, which we call the sustainability lens product set, which includes not just active equities, where we have global equity and regional equity capabilities, but also some fixed income in the form of high yield and investment grade. So reasonably broad product set, and what's not shown here is our private markets capability, which is providing a different source of revenue for us. And I'll say a little bit more about that as we go through. Next slide, please. So we've developed around 17 investment strategies, which we're making available to our clients in different funds and accounts. So we're running over 80 funds and accounts, each of which picks from one of those 17 strategies. And the funds and accounts are sold in different parts of the world. So, for example, our environmental leader strategy, which is the largest of the thematic range, has more than a dozen funds and accounts in different parts of the world. There's a Japanese version, there's a Canadian version, there's a Danish version, there's an Irish version, etc. So what this chart shows is the layout of our approach to our client base. And just starting from the left of the chart, you can see in North America quite a number of partners, particularly in Canada, but we also have a big sales team in the US, which is selling our own mutual funds, as well as more limited partnership type vehicles, collective investment trusts, etc. In Europe, we have our own funds range domiciled in Ireland. We have an investment trust called Impax Environmental Markets, and then we have both direct sales, for example, in the Nordics, but also some partnership work that we do with the likes of BNP Paribas Asset Management, where they brand the funds and we do the sub-management work. That's given us a ready route to scaling our business over the years. And then further on the right, in the Asia Pacific region, then we have a research team in Hong Kong, but we have most of our business in the area, either in Australia, where we use a partner called Fidante, or in Japan, where for many years we've been using BNP Paribas as a sales agent, and we're just about to set up a small client service office. So I think if you were to compare us to other listed UK investment managers, what really stands out about Impax is not just our investment philosophy, this idea of a transition to a more sustainable economy, which is quite hard to navigate, but also our client distribution. So nearly 80% of our clients coming from outside the UK. Next slide, please. So this is a summary of our financial results to the end of September. So we have reported positive net flows of £2.9 billion in that 12-month period. This is also a differentiating feature of the firm. So one of the few investment management firms in Europe and North America to have reported positive net flows for 2022. So that was a creditable result. And actually the flows have remained positive into the first 2 months of our new financial year, i.e. October and November combined, and together with reasonably positive market movements in those 2 recent months, by the end of November, we reported on our website £39.2 billion of assets under management. And that compares to just over £37 billion 14 months earlier. So we've been able to deliver that in spite of the very tricky market headwinds, but really enjoyed the positive client sentiment and positive outlook around our investment thesis from our clients. We haven't lost any clients in that 12-month period. Some clients have redeemed a portion of their holdings from collective funds, but we haven't lost any clients. We've launched 10 new funds and accounts in that 12-month period, and as well as winning some awards, as is shown in the bottom right of this slide. Next slide, please. So a summary of the financial results with the most recent 12-month period shown in the dark blue bars and the previous 12-month period in the mid blue. So you can see on the left-hand side quickly that we've had a significant step up in revenue and in profits and EPS. And then on the right, you can see in particular the bottom right, a 34% increase in our annual dividend. So we aim to pay a progressive dividend, and we now pay a small interim dividend and then a larger final dividend, subject obviously to shareholder approval at the annual general meeting, which will be in the middle of March. Next slide, please. We've also announced that our long-standing CFO, Charlie Ridge, who I think has been on some of these share stock calls in the past, is taking retirement from management, moving to a plural non-executive career, and we're delighted that Karen Coburn is joining us, having had a long career in banking and insurance. So she'll be our CFO from January. So she's been with the business now for 3 months for a handover with Charlie, and Charlie will be remaining on board as a part-time advisor for 2023. Next slide, please. So we also like to report how the change in assets under management evolve through the year. So the bottom half of this slide is the result in the first half, the 6 months to the end of March. So you can see the strong positive flows, so inflows greater than outflows in spite of negative market movement. And the negative market movement was exacerbated in the second half, i.e. the top half of this page, and the flows remained positive, albeit the net result was reduced compared to the first half. Next slide, please. So just a few comments on the market environment. Very clearly, it's been remains a very difficult macroeconomic environment with rising inflation, rising interest rates, and very significant pain caused by energy prices, largely linked to the Ukraine invasion. There has, as a result of weakened market sentiment this year, been a rotation of investor sentiment towards value stocks away from growth stocks. So although Impax does have a tilt towards growth stocks, we very much have at a reasonable price discipline. So constantly looking for cheap growth, if you like, and that growth at a reasonable price discipline has helped us to outperform most of our peers in 2022 to date. So during the year, there's been, of course, a series of surprising, if not shocking, weather-related problems. So we've had unbelievable floods in places like Pakistan and Australia. We've had record heat waves in Europe and wildfires in North America, just to name but a few. So in the context of this worsening weather and climate-related situation, then it's no surprise that the policy support for the transition to clean energy and energy efficiency is accelerating with, for example, the US Inflation Reduction Act and similar policies in the European Union, China, and India, just to pick a few. So the next slide, please. In that context, we do think that the drivers behind our investment thesis are continuing to strengthen in spite of fragile investment sentiment, and that's also compounded by regulators' move to prepare for mandatory labeling, green labeling of funds, for which Impax is in a very strong position to comply swiftly and cost effectively. So in that sense, we continue to be well positioned. We have a global brand in a space that investors continue to want to allocate to. We have a very well-established and successful investment team that is part of our management group that owns 20% of the business. And we have a fabulous client base all around the world with relationships that can be extended through further nurturing rather than needing to initiate from a standing start. Next slide, please. So a little bit more breakdown of our assets under management. So if you remember, I said we were running thematic environmental market strategies, which are the ones shown in blue, and our sustainability lens or core products are shown in orange here. So on the right-hand side, you can see that from a relative perspective, there was, the end of the period, higher percentage of our funds under management in the core space compared to the thematic space, core space being more attractive during choppy markets for new flows. Next slide, please. And if you slice our assets under management up by revenue and by assets under management, you can see that the breakdown between our third-party funds, our own funds, and BNP Paribas labeled funds. And BNP Paribas is our largest shareholder, represents about 14% of our shares, and we've had a distribution relationship with them since 2006. So you can see on the middle bars of the right-hand side that on average during the year, they represented about 30% of our revenue. And in September, on the margin run rate basis, that was about 28%. So we enjoy a very successful and mutually beneficial relationship with them, but we are along the edges looking to build more direct sales, particularly in North America and certain parts of Europe, so we can further diversify our revenue source. Next slide, please. So I've said a couple of times, the UK is just over 20% of our assets under management. That's on the left-hand side of this chart, with the EMEA region ex-UK being about half, and North America quite nicely positioned there and set to grow as a percentage of the total. That's the source of the clients. Next slide, please. So where did the flows come from? The net inflows of 2.9 billion. Well, more than a third of them came from St James's Place in the UK. That's what's shown on the left-hand side in the dark blue bar, which shows a very strong performance. The rest of the UK was pretty flat. There's a little bit of outflow from the LDI related redemptions that pension funds were forced to go through in the latter stages of our financial year, which we think has now completely sort of washed through our system. It wasn't a big impact, but it's has left us with a sort of nil result outside St James's Place in the UK. In Europe, then continental Europe, then BNP Paribas was a little bit negative, and that was offset by distribution with other white label partners, for example, Lombard Odier, with whom we established a new account during the year. And then on the next slide, picture North America was strong across the board with positive dark blue bars, and then equally in Asia Pacific region. So we're seeing increased success in sort of ex-Europe, if you like. Next slide, please. So a couple of pages now with quite sort of dense slides on our investment performance. I think the key thing to do here is look at the length of the dark blue bars, which is our investment performance over 1, 3, and 5 years, versus the mid blue bars, which is the index or benchmark. And so there's 5 sets of data here for the 5 sustainability lens strategies, and you can probably see that over 3 and 5 years we're typically beating the benchmark, but somewhat behind over 1 year to the end of September, which is really reflecting the fact that we're in growth-oriented sectors and stocks which have been out of favor. That modest underperformance has been reversed largely during October and November. And then on the next slide, which is the corresponding information for the environmental market strategies, again, compare dark blue, which is us, against light mid blue, which is the benchmark. Then again, good 3 and 5 year numbers, broadly speaking, with the 1 year numbers being a little bit worse than in the previous page, but the recovery in October and November also a little bit better. So still very well placed for reassuring our clients that with a medium to long-term perspective, this is an excellent place to invest. Next slide, please. We haven't been slow in looking at new product opportunities. So that's new wrappers for existing funds and accounts. For example, what I mentioned with Lombard Odier, which was a US large cap product. We have also launched a few weeks ago a new long only strategy in the listed infrastructure space with an Impax flavor, if you like, into digital infrastructure and sort of services rather than lots of poured concrete. And we are also looking at ways we can expand our fixed income and private markets operations. Thank you. So in addition to pursuing great risk-adjusted investment returns, what our team is also well known for is its work in the non-financial area. And this is increasingly prized by our clients and seen as a way, or we see it as a way of enhancing our brand. So we are gleaning policy-related information for our investment ideas, but we also have a 3-person team which is doing advocacy work to try and sort of ensure that regulations are shaped in a way that leads to rapidly growing markets for us to invest in. we're doing a little bit of research work in topics such as physical climate risk and biodiversity, and we're playing our role and playing a part, sometimes quite a prominent leadership role in the various industry groups around the transition to a more sustainable economy issues. And then 2 further areas in this bucket, so engagement and stewardship. So we are active owners of the shares that we, or active relationship builders rather than activist investors. We look to invest in quality companies, but we do have a keen eye on helping them to improve. And we're also leaders in the area of impact reporting for example, environmental outcomes. The people in our business, of course, are right at the heart of the success of our operations. So we've increased our headcount this year by 26%. You can see the breakdown in the different geographies. Crucially, you can see the very large team that we have in the US, which some of which came from the IPX acquisition that we made in 2018. But we've more than doubled the size of the team since that acquisition. We've opened an office in Manhattan this year, which was sized to be cautious post-COVID, but we've actually seen a very strong uptake in the interest in people going to that office. So we'll be firming up a long-term lease for that office and making good progress on the gender diversity of the team at all levels. Next slide, please. Inevitably, we have to invest further as we grow in compliance and risk management and in IT. So our business is scalable, but we do need to make sure that we've got adequate resources going into these areas to ensure that we've got a resilient operation. So a number of projects underway in these areas and more people joining incrementally. So that's a sort of key part of attention for area of attention for our board to make sure that that's all working very well. Next slide, please. So just wrapping up, and I think we'll move to questions in a couple of minutes. I think what I've tried to convey in going through these slides is the fact that Impax is in a really excellent position for further growth. We are well established globally as a brand that's seen as authentic and experienced in a key area of the economy that, all being well, will deliver growth and complexity and therefore opportunities for experienced investors for a couple of decades to come. The scale of the opportunity is such that we ought to be able to double the size of the assets under management without much contribution from products that we're not currently operating successfully, i.e. we don't need to do too much product development and proving to double the size of the business. So we have to go beyond $100 billion or so, then I think we will need new products, which is part of the task for the next few years. Scalability of the business is also based on the fact that we can access additional pockets of capital with a relatively small number of new hires in distribution or sales on the one hand and corporate services or fulfillment on the other without a big increase in investment headcount. And so the net result of that is that the financial model looks pretty compelling as we grow. So we should be able to further expand our operating margin. In the very short term, of course, markets are choppy and there's uncertainty about the central bank response to the current situation with inflation. So there's definitely a strong probability that 2023 will be a year of volatility for markets. So we will carry on with our growth at a reasonable price investing. We're hoping to deliver positive returns. And in the meantime, we are continuing to sort of build the capability set to deliver on a medium-term potential, but at the same time being quite sort of prudent about how rapidly we do that, because we don't want to be loading it with costs until market sentiment is a bit more stable. So let me finish there, and I think there's a good chunk of time for some questions. So back to you, Cliff.
Thank you very much. Thank you, Ian, for that fabulous run through of your company and the way it's developing. And I picked up particularly about you saying you think you've got the scale of operations set here to be able to have 100 billion of assets under management. That's quite a vision. What sort of timescales are you viewing that?
Yeah, so just to make sure we've got the currencies right, so that's $100 billion compared to today's $47 billion, which equates to 39.2 billion pounds. So that's the doubling of the business in scale. So the time frame for that is very hard to project because it really is a function of market sentiment and, if you like, investor confidence. So I think if market sentiment improves in 2023, then I think it's not out of the question that we could be hitting those sorts of targets in 4 or 5 years. If market sentiment remains rocky for 2 or 3 years, then I think that pushes back our time frame. I do need to stress that our ability to get to those levels does depend on continued good investment performance and continued sort of resilience and quality as perceived by our clients and their advisors. So this is a highly competitive industry. There's no guarantee we're going to get to those targets, but I think our track record over 25 years shows that we are pretty successful in a sort of medium to long-term sense, building a resilient investment management firm. So I hope that our investors have confidence in the management that we'll keep on going, and we're setting ourselves quite an ambitious target, but we're certainly being sort of prudent in showing what might go wrong as we continue to scale.
Yes, and picking up on your investment performance and the numbers, the 3 and 5 year numbers, and the long-term numbers are terrific, which is what's driven your growth in the past. We've now seen this slowdown. Could you give us a feel as to how you're seeing this as a result of fund performance changing? Is it market sentiment? Is it there's quite a lot of money been taken out of the market, the fund markets overall, isn't it? I'm not talking about your sector. I'm talking about overall. Is that one of the reasons why your rate of growth has slowed down?
Well, yes. In 2021 to the end of September, we brought in 10.7 billion pounds. In 2022, like for like, we brought in 2.9 billion pounds. So that is a significant slowdown. But as I said at the start of the presentation, then we're pretty unusual in the asset management world in reporting positive flows at all, because the vast majority of our peers are showing negative flows, so outflows. So I think that there's been a general sort of tide going out of risk appetite or fall in risk appetite this year for reasons that are well rehearsed, and I summarised at the start. What I think we're trying to get across is the fact that our investment idea and our investment quality is such that investors do think that Impax is worth sticking with, and actually on balance have been giving us more money to manage.
Yes, and I can probably give you a plug here. I'm not sure whether you're entitled to say this or not, but I've been looking at the equity development note and the funds flowing in, and over the last year you were at the top of their list. And CL, City of London, that they're growing, but the others were all shrinking their funds: Polar Capital, Lion Trust, Premier, Jupiter, and Ashmore. So you're right at the top of that list.
Yes, thank you for pointing that out.
Yeah, but they're generalist, more generalist fund managers. Could you tell us about your competitors in the particular sector area which you're specialising in?
Yes, of course. So we're focusing in 2 areas, as I said. So thematic investing around environmental markets, where there's a relatively small number of high quality peers. So there are funds run by Natixis, by Pictet, by Nordea, that would cross the desks of consultants looking for high quality offerings, as well as Impax. And then in the second area, the sustainability lens or more core products, then it is really a much more competitive space, with all the well-known global equity players having some interest and story to tell around, for example, clean energy. So the likes of Baillie Gifford and Wellington, but many others as well. So Impax in that second category is differentiated because of the sort of uniqueness of our investment philosophy and the sort of strength and depth of our team. But we've spent more than 2 decades honing our investment process and our communication of the investment process to impress the gatekeepers, which is why I think we're still winning mandates in that more competitive space.
And those other ones you mentioned, like Bailey Gifford, they are not niche players like yourselves. They're
yes, correct.
BlackRock. Yeah. Well, I think BlackRock are in this area, but maybe they're greenwashing. We're not quite sure. I'm not asking you a question there. One coming in here from Martin is, it says demand for your funds is growing, and as you've shown in your presentation. But what about investable stocks or companies? Many recently listed tech companies were vastly overvalued.
Yeah. So when we first launched listed equity investing in 1999, we actually came up with a green taxonomy or classification system, and we found about 250 stocks that had a majority of their revenues in these areas. And on a like-for-like basis, that number of stocks is about 1,250, 1,300 today, and is set to be growing in the future. So one of the features of rapidly expanding markets in the areas I've described is that there's innovation, new businesses, spin-offs, reorientation of existing companies in the direction that we would like to invest. So what we're not doing is investing in unprofitable tech companies. That's never been a feature of Impax's process. We almost invariably invest in profitable businesses, and key component of the sort of quality assessment when we're looking for investments is to see profit, but also diversified business models. So yeah, if you look at, for example, the hydrogen economy, we have quite limited exposure there because there's very little in the way of revenues to be gleaned from supplying hydrogen, certainly so-called green hydrogen, without associated greenhouse gas emissions. So it's, in that sense, the hydrogen economy is too early for Impax.
And you've shown us a lot of new products, which areas you've been moving into, and I think that's related to your increase in your headcount and therefore presumably future increasing costs. I'm not quite sure if I've got this right, so perhaps you can clarify this for me. But this does come back to this point that you think you can achieve this long-term growth target with the existing product range. So it sounds like you're now well set up for your next part of the strategy, moving to the next level. That's the basis of my sort of question.
Yeah. So the way that Impax and other businesses like us deliver value to customers is through the development of a portfolio of stocks, which, for example, is a 40 stock portfolio. We call that a strategy. It might be, say, a portfolio of water stocks, so that will be a water strategy. Now that strategy is then available to be packaged in different legal structures for different types of clients around the world. So I talked about our leader strategy, which is a 45 stock portfolio, which has over a dozen different funds and accounts that derive from it. So the core of our growth plan from today's 39.2 billion pounds, 47 or so billion dollars, is to attract more capital into the funds and accounts with the 17 strategies we have today, to launch new funds and accounts based on the same strategy. So, for example, to take the leaders product into Malaysia or Abu Dhabi, to pick random examples, which of course requires a little bit of legal work and compliance work, but doesn't require much of anything in the way of additional investment work. And then thirdly, to launch some new strategies. So our listed infrastructure strategy that I referred to is one of the few new strategies we've launched in the last 5 years, and currently is available through just one of our fund platforms, the Irish one. But we're open to investors or clients asking us to launch or to run that strategy in a different fund wrapper. For example, one of our Canadian partners might ask us to run a Canadian version. So the combination of those different types of growth does result in a plan which is highly likely, subject to all the success factors I mentioned before, to lead to rising operating margins and therefore an ability to pay rising dividends on the back of a slowly growing team. And that's quite different to saying, well, Impax should be experts in hedge funds and therefore should be hiring a big hedge fund management team and all the processes and IT systems to run hedge funds successfully. That will be a less profitable way of growing our business.
And much more risky, so I'm glad you're not looking at that. You're talking about rising margins, and I understand what is just answered there, but there's a question coming from Simon about the other side of the margins, is the income side. What is your strategy on fees and in an increasingly competitive market, and how does that link with the assets under management growth target?
So generally, what we try to do is charge a plain vanilla annual management fee rather than have complex performance fees. And we also try to size or price the services we run in the local market in a competitive but not sort of grasping fashion. So middle of the road annual fees, annual pricing is the tactic there. That might mean that in, say, Sweden, we are running an account at 40 basis points, 0.4% per annum. The same account in Canada might sell for 50 basis points, 0.5% per annum, because the Canadian market has got a somewhat higher willingness to pay than the Swedish market. So if you look at the blended fee rate as indicated in our longer shareholder presentation on our website, then the weighted average fee margin for the year just gone was 47 basis points. And for the previous 12 months, it was also 47 basis points. That's been coming down slowly over the years as our business mix has moved towards that more sort of third-party white label funds and accounts where we have sort of slightly lower net fees to ourselves. That was a particularly significant reason why we've hired more people into our sales team in the last 18 months, including 2 new leaders in the US and Europe, respectively, in order to ensure that we're getting high levels of fee. And therefore, we think we've got a good chance of preserving the revenue margins in that sort of mid to high 40s over the next couple of years.
Okay, well, thank you. Can I ask a question about the share price and factors which influence the share price, specifically about who? Can you tell us about who's been selling and who's been increasing their stakes in the company?
Yes, I mean, I'm sure you know better than me, and there's a limit to what I can say about the share price, but the shareholder register, which is sort of available for public consumption, is that BNP Paribas is the largest shareholder at about 14%. Last time I looked, which was recently, I think funds run by Lion Trust rather than Lion Trust itself. So funds run by Lion Trust are the second largest shareholder, and then I'm actually on a personal basis the third largest shareholder. And then funds run by Aberdeen, Henderson, BlackRock, and JP Morgan have been above the 3% threshold. And I think a majority, possibly not all of those, are at the moment. So that's a long-winded way of saying that probably, and then management owns 20%. So if you think about 1/3 of the company owned by management, including myself and BNP Paribas, 1/3 of the company owned by typically UK-based small cap managers, and then 1/3 of the company owned by a long tail of investors, including yourself, Cliff, and by the sound of it, and some of the people on this call, then that's been a pretty stable picture now for quite some time.
And that's a fairly stable group of BNP and yourself and management. But I think Aberdeen have been reducing their stake. Am I not right?
I'm not sure about that, but it's quite possible. But at the same
Yeah,
time, quite a number of these
maybe it's
managers.
something it's not you don't watch, but
Sorry, just a quick point on that. So I can't comment about Aberdeen, but I do know that because of the outflows experienced by a large swathe of our industry, then quite a number of small cap managers have had to meet redemptions. And so if they're selling individual small cap names like Impax, it isn't necessarily because they're taking a negative view, it's because they've got to find liquidity to meet outflows from their own funds.
Right, and liquidity is an issue very dear to my heart because of all the work ShareSock's doing on the Woodford campaign.
Right, indeed.
Yes. So it's always the question with share prices that in the short term it's the balance of buyers and sellers, and we've seen a very significant change in the share price. It's been very volatile over the last year or so, and in the long term it's based on the actual value being generated by the company. Yeah. And I think a number of people on this call will be interested to know when sentiment's going to change, but that's really being somewhat godlike to be able to predict that. I'll move on to another question from Martin Ferreira. Is there a particular geographic regional strategy that offers the best growth opportunities?
I assume that Martin means, but in terms of clients rather than investments. Yes.
Yes, I think so. I think it's on the. I think it's on the income side. He's thinking from that point of view.
Sure. Yeah. Well, I think historically we've enjoyed great success in Europe, including the UK. It's been our home market. It's a market that's well attuned to our investment idea. But actually, more recently, we've seen, as you've noted from the slides, more success in North America and actually also in the Asia Pacific region. And I think that's a combination of two factors. One is rapidly growing asset owner interest in what Impax does in these regions relative to historical levels, coupled with a lack of a product, a lack of sort of credible investment managers. So this is one of the reasons why we made the Pax acquisition for nearly 5 years ago, to get a big US team, and we've been investing in extending that team. And it's also why we are launching or establishing a client service office in Japan, and excited about our partnership with Fidante in Australia. So we're deliberately positioning the business to be able to pursue new opportunities in all three geographies. But if I had to rank them in terms of excitement from here relative to where they have been, I would definitely put North America at the top of the list. And I would say that Europe is still exciting, but there's a potential for Asia, particularly Japan, over the years to be quite a nice positive surprise.
And has President Biden been a positive influence for your business in North America?
Broadly speaking, yes. I mean, I think the most important step that President Biden took was to push through the so-called Inflation Reduction Act, which essentially was a set of policies to provide a strong financial incentive to move towards clean energy and source goods and services from domestic US companies to that end. So that's been very, very positive, both for near-term earnings and also sentiment around many of the stocks that we invest in. So yes, that's been a very positive step forward this year.
Okay. Well, I think we're probably coming to the end of the questions. It's been a very, very interesting run around your company, understanding where you've come from and the strengths of your business model itself, and where you're planning to take it. I found it extremely helpful. I hope everybody else listening to this call is. It will be recorded so people can watch it again, and I think that will be useful as well for people. Thank you very much, Ian, for your time and for the diligent and thoughtful way in which you run your business in what's a very, very important industry, to making sure we have a sustainable economy going forward. Thank you.
Well, thank you, Cliff. I really appreciate the opportunity to update everybody. Appreciate the support from those of you that have invested in the firm, and look forward to staying in touch. There's more information on our website, including a slightly more detailed slide deck and a few videos, and very happy to get some feedback and anything else you'd like to see in the future. So look forward to staying in touch.
Thank you. I'm certainly more positive as a result of this.
Excellent. Okay, thank you. Have a good evening.